Ladies and gentlemen, good morning and a very warm welcome to the launch of Proshare's 2025 Nigerian Capital Market Report. My name is Uche Uwaleke, Head of Business and Markets at Proshare. I am your host for the next 2 hours, and it is an absolute pleasure to have you all join us today for this event. We acknowledge the presence of investors, regulators, market operators, development agencies, media houses, and representatives of financial institutions and companies across various sectors who share a common interest in the future of Nigeria's capital markets and the economy. Before we begin, let me walk you through today's agenda. We started earlier with a poll, which I believe that we had done that. We had casted our votes on the poll, and thereafter moved to the opening remarks from the founder of Proshare, who will set the context for today's launch. Following that, Tosin Ige, our head of research, will present key insights and findings from the reports. After the presentation, the moderator will facilitate an in-depth discussion with our speakers, followed by an interactive question and answer session. As part of our engagement model, we will conduct polls intermittently to measure the public's pulse. These polls will be available on this platform Zoom and across our social media X, LinkedIn, IG, and WhatsApp. The results from this platform will be shared in real time, while the broader results from our social media channels will be compiled and made publicly available a day after the event. Allow me to set out a few housekeeping rules for the webinar to ensure a smooth and productive session for all attendees. For all technical issues, kindly use the chat forum and direct same to the host. All attendees' microphones are muted to prevent interference. Should you have any questions, please feel free to submit them via the chat box. Compliance with decorum standards within our governance ethos are in place and will be activated even as we encourage everyone to freely express themselves. And finally, please note that this webinar is being recorded and live streamed on WebTV YouTube page, Proshare X, and Facebook platforms. By attending this webinar, you acknowledge and consent to recording your participation, including any questions or comments you contribute during the session. Proshare may use the recorded content for research, educational purposes, or future events. On that note, I now welcome Mr. Olufemi Awoyemi, MNI, for his opening remarks.
Thank you and good morning. This time last year, we were confronting a crisis of confidence in the economy, where uncertainty mixed with fear to deliver what I call a perfect storm, an especially bad situation where a rare combination of circumstances aggravated a frail situation drastically. I recall having to give a keynote address to a distinguished panel of senior economists on how the policy decisions taken in 2023 tipped the delicate economic balance of options overboard. And yet, it offered us a new challenge. Today, while we are not out of the woods yet, we have a less pessimistic view of the country and its market. We released our 2025 economic outlook in December 2024, which signposted the evidence of our national resilience to withstand strains and stress at a micro level, yet highlighted the unresolved pain points in our microeconomics, the household. As we noted, the difference between those who succeed and those who do not is revealed in how the sovereign strategy, the structure and systems are designed to help the people overcome such a difficult time as we are in. Those without strategy do not have a destination, and those without structure do not have an implementation spine. And inevitably, those without a resilient system cannot go far. Nigeria now has a pathway, and despite the gloom, we appear primed to confront the hard choices needed to deliver the change we seek. And for those who desire growth, pursuing purpose over popularity must be the basis of engagement. It was therefore clear that the time has come for us in the private sector to seek a new way, a new compact to engage, a mind shift where our truth must be delivered through a solutions-based approach. This mindset informed the desire to create an event around a best effort report produced by Proshare Research one we would otherwise have released in the first week of the year when it was concluded. The management thought otherwise, and we decided that the output from the hardworking team of researchers and analysts assembled deserved further exposure, both as a learning opportunity for our firm and as a narrative agenda-setting intervention for the necessary conversation needed to build on this recovery momentum. In this report, which Tosin Ige and his team will share with us, we built upon the 2025 economic outlook, took a deeper look beyond the numbers to challenge ourselves to bridge the gap between the federal government's mission of delivering a $1 trillion economy by 2023 and our current reality, considering also what a rebased economy might look like using our own models. But not just in terms of the final numbers, but we attempted to reimagine the sectors of the economy by moving them into economies from just the 46 sectors that you see. Most importantly, we imagine how the private sector can support with the heavy lifting now required to deliver a win-win result. The report presented today, therefore, reflects foundational thoughts on this crucial and game-changing approach to economic life, one that seeks to catalyze the views of economists and capital market experts on this part. That said, this report is a first of many in an ongoing project on the theme for which our initial engagements with critical sector players have thrown up a number of issues. None the least, the much awaited rebasing figures by January 30th and delineation of economic sectors. There's also the issue of revisiting of master plans as a component of national development plans, as well as the issue of foundational enablers for the economy. We also note in our report that there are gaps in the governance architecture able to deliver a capital market supported economy. Personally, I am particularly keen to see such an engagement as we have today to identify the nexus between an area I consider very important, which is the household, something I consider to be the common denominator in an economy. That how does all these numbers help the household so that it can support consumption in the country and also be able to energize the stagnating retail investor space to create value in the economy. More importantly, I observe two issues I hope the panelists and the public will take up as well. In our explorative interpretation of possibilities, we had a lot of considerations to overcome, which we believe the MBS would consider, confront, and contend with. They, unlike us, have the responsibility to resolve these pain and flashpoints. That being said, our calculations relied on publicly available historical GDP data and an interpretative understanding of the fixed base methodology in contrast to the chain-linked methodology of the National Bureau of Statistics. The outcome of the independent explorative rebasing calculations would suggest that Nigeria may come in at above 400 billion, or precisely about 490 billion, making it inch closer to a 1 trillion economy than was previously thought. We posted that achieving this goal would require an appointment of the required GDP growth rate, as Tosin and his team would also present. The targets they provide means that we can only deliver on those things if we re-strategize, repurpose, and refocus the domestic capital market approach. And listing of a few state-owned enterprises in 2025, as was done in Egypt, where over 30 enterprises were listed in 2024 alone. Another outcome of Proshare's research suggests that the country needs to identify what it owes, what it owns, and what it can sell through a market-determined process that ensures valuations can look into the future yields. To achieve this, we align with the school of thought that believes that in collaboration with other ministries in a whole of government approach, the Ministry of Finance Incorporated, MOFI, would need to create an asset registry included in a national deal book available to local and foreign investors. This school believes asset sandboxes can be created where relatively lower value assets are sold or leased within an experimental deal. Finally, based on available public data and market intelligence, we have chosen to take a detour and move towards optimism while recognizing these underlying difficulties and limitations in our capital market as are responsible. We have chosen to do so knowing that the obstacle is the way. This session today, therefore, is not intended to be another talk show, but a reasoned attempt to signal options out of the crossroads we are confronted with, rising beyond the noise. I expect, therefore, that the contributions of our esteemed panelists and the questions raised by our participants along with the report presented today, will serve as an opportunity for a deeper and broader conversation on the rebuilding efforts for a new country. Thank you, and have a wonderful session.
Good morning. I am Oto Abasi-Abasiekong, Head of News at Proshare. I'll be moderating the panel session, but before the discourse, we will take the second poll for this webinar, and I urge everyone to participate. Thank you to all our participants for engaging in the poll. I will now invite Mr. Tosin Ige, Head of Research Proshare, to give us an overview of the report, the 2015 Capital Market Outlook Report, in the next 15 minutes. Welcome, Tosin.
Thank you very much for having me. Good morning, everyone, and all protocols observed. In the next few minutes, 15 minutes, as I said, I intend to present an overview of the Proshare's Nigeria's Capital Market Outlook Report 2025, which will tag the capital market and the quest for $1 trillion economy. And in doing that, I will take our usual inverted pyramid approach, which of course looked at the global, Africa, and then domestic markets. I will wrap that up by presenting the context for the capital markets and the $1 trillion economic discussion by our panelists. So I'll move right into it. So for the global economy in 2025, one thing our report finds out is that the market actually sustained its liquidity, because that supported the equity market. We saw the MSCI index, the MSCI World Index returning 17%. And when you put that into context, it is because, again, in the developed market, we see monetary policy easing. And so that supported the global market liquidity. And of course, equity market benefited from that. When you look across the major regions, the US, the Europe, and then the Asia, you saw markets were likely positive. And in the US, supported by the optimism around the artificial intelligence and of course tech stocks. And then in Europe, we see the monetary policy easing also contributing to the market performance in that region. And in Asia, we talk about the stimulus support by the Chinese government and all other activities from Japan also supporting the market. In the same way, the commodity market also benefited from the global market liquidity and perhaps also because of the geopolitical crisis, which of course offered gold and silver as a safe haven. But when you flip to the other side of the Brent crude futures as well as the WTI, we saw that they trended downward for 2024 because of the unwinding from the OPEC as well as the weak demand from China, all contributed to the downtrend we saw in the commodity market. But Africa, as it is not excluded from the global market liquidity. Africa benefited. We saw major exchanges returning positive in 2024. Ghana led the charge with 56.17%, and we saw Nigeria in the fourth place with 37.65%. That's the NCM All-Share Index reform in 2024. But this is the domestic currency term. When we flip the argument into the dollar term, we notice that some drop because of the currency. So we saw that Kenya is now leading the chart when we go to the dollar term, and then Ghana moving to like 6th place, and then Nigeria dropping even to the negative territory, suggesting that foreign investors may have been burnt in terms of the return on their money because of the currency risk, which is rather a peculiar issue to most African economy, as it were. So I moved to the domestic market. Generally, we saw that the Nigerian market, even excluding the currency from the FMDQ, yet it lead the market, the Nigerian market in 2024, owning 53% of the market in terms of the share of the capital market in 2024. And then we saw NGS with 42, the market capitalization of NGS with 42. But one of the things we notice is that the commodity ecosystem is yet to fully take shape in the Nigerian market, talk about the Lagos Commodities and Future Exchange, as well as the FX, the return. They account for less than 1% of the Nigerian capital market in 2024. Yet, this is one of the areas we actually feel that we are yet to unlock a capacity that can deliver more from that market. But as I said, from the global market, the liquidity that we saw on the global market, which trickled down into Africa, Nigeria also had its fair share in domestic currency, because we saw demand from foreign investors, which also grew because of the liquidity we saw on the globe. So markets generally in Nigeria were positive for 2024. And because of that, we saw the Sony Insurance leading as the top returning shares on the NGS for 2024, followed by Wando as well as Transcorp. These three leading in terms of return for 2024. And on the flip side, when you flip the argument, we saw VFD Group, Multiverse, as well as the Dangote Sugar at the bottom of that ladder. Now, these are they are industry-specific issues, because in Wando, Proshare wrote on the optimism around the Ohando, as well as the Dangote Sugar and other issues. So our audience could access some of those information on our website to read more. And but for the fixed income market also, we also saw some optimism. If we benchmark that with the NTB auction, we saw a number of activities at the high end, the 365 days in the NTB auction, where we saw oversubscription through the years. And in the same thing happened to the bond auction, where we saw a number of oversubscription in the bond market. And in the money market, now we were quite specific on this in the report. Now, one of the arguments has always been that the monetary policy rate, the argument whether the monetary policy rate signals or influence other rates in the system. And our argument has always been that the monetary policy rate neither influence nor signal commercial lending rates. And with data that we worked with, that shows from the data reported by CBN that the monetary policy rate largely, of course, influenced the overnight and open repo rate through 2023, 2024. But what we notice is that the commercial lending rates, which we benchmark with the maximum lending rate as well as the savings deposit rate, were largely flat, which of course reinforced that our positions that the monetary policy rate is neither effective or no, whatever we call it, in terms of influencing the commercial lending rates. And we may need to look at, maybe because we attribute that to the fact that we're not a credit system, and even some research by some international analysts also shows that in some other climates, it is the policy rate is really rather ineffective in influencing monetary policy. That's why we're looking at, let's look at the fiscal side in our report. So the local commodities also performed the same way. We saw positive return. But one thing we noticed is that supply shortages actually influence some of the issues, some of the uptick we are seeing in the local commodities, because we really have supply shortages in terms of across all the commodities that we track on the local scene. So moving into the discussion of today, which, as we said, is the capital market and the quest for the $1 trillion economy. So to present an historical context, we look at the last rebasing, which is the 2024, the 2014. And for GDP, one of those things we noticed that immediately after the rebasing of the GDP, GDP shoot up. And that's the chart on the left-hand side. And immediately after the rebasing for the inflation, we notice that it came down. But again, from the chart, we find out that these things, like the GDP that goes up or the inflation that goes down, they are often quick to revert. Like the GDP, we saw that uptick after the rebasing, but yet it went back down. And then the same thing for inflation, went down, yes, but it was quick to revert upward. So, but for this, the current rebasing effort, one of those things, as it has been mentioned earlier, is we did an extrapolative rebasing possibility that with the current effort to rebase to Nigerian GDP and inflation, what are we likely to see? And then, well, of course, we assume that the MBS is unlikely to change the 46 activity sector that we have. And so, from their home context, this 46 sector is largely classified into about 7 to 8 industries. And that's what we have on the left-hand side, where we have the 2019. But on the other hand, we at Proshare, we look at the 46 sector being an array, a large array of activities that doesn't allow for a streamlined allocation and monitoring. So we said, let's recalibrate the sectors into 14 sub-economies. And so we have it there. We said the creative, the lifestyle, the digital, services, education, health, mobility, energy, mineral, blue economy, agricultural, trade, industrial, as well as the construction, to 14 key economy. And our argument has been that without the rebasing, the current efforts we have, if we use 2019 figure, we're in dollar terms, we'll be having like 470 billion without rebasing. And for 2024, without rebasing, using the current exchange rate of the last year, the year-end exchange rate of 1,544, we'll be having our GDP at about $161 billion. But in our home calculation, when we did the rebasing using changing the base, of course, bringing up the base to 2019 in line with the MBS proposal, as well as reweighting some of the sector, we found out that if we rebase, we're likely to achieve about 490 billion, which leaves us with a gap of 510 billion to the $1 trillion economy. Without the rebasing, that would have been around, the gap would have been around 838 billion. But with rebasing, the gap is around 510. And our argument has been that we can achieve this gap, the 510 billion gap to the $1 trillion economy, we can achieve it. And there are 3 proposals. We say, let's leverage the capital market, let's securitize and finalize some of our high-do and even active national assets. And at the same time, let us incentivize growth in key sectors that we have identified. Our estimate of what each of these categories can deliver is quite detailed in our report. And basically, we also put them into sectors. As I said, the 14 sectors, we did that extrapolation to give us what each sector can deliver specifically with the weight. And of course, you agree with me, the digital economy, as we have argued, is one of the creative economy, as we have argued, is one of the sectors that is currently thriving. So we weight some of those sectors and we took it, and we are quite confident that we can actually meet the $1 trillion economy if we streamline our operation as we have argued. Overall, we are looking at between 13 to 15% annual nominal Naira GDP growth to between this 2025 and that 2030, that the government is targeting the $1 trillion economy, that we can deliver that. And on average, that's an average annual GDP of 10 billion added to the GDP, sum up to $1 trillion in that in 2030. So let me conclude by saying that the $1 trillion GDP aspiration in the next 6 years require reimagination, capital market repositioning, as well as the public policy repackaging. And our argument is that rather than getting stuck in the memories of the past, the federal government needs imagination to see this $1 trillion economy as we are seeing. And what we argue is that let us take an unorthodox approach, because the current construction of the economy as we are using with the budget, the current design, is unlikely to deliver the $1 trillion economy. So we need to take a different approach. And what are those things we argue? Let's financialize idle public assets through securitization. Let us prioritize capital market funding of projects itemized in our medium-term expenditure framework, as well as let us broadening the scope of FMDQ such that it can list public sector equities. Now, FMDQ definitely has equity license, and so because of their public sector relationship, we can leverage that exchange to list public enterprises. And lastly, we are saying, let's deploy fiscal and monetary policy incentive to emerging growth areas, as we have said, the digital, the creative economy. We have all listed that, and they are all details in our report. Thank you very much.
Thank you, Tosin, for the enlightening presentation on the 2025 Capital Market Report. Very clear that there's need to reclassify the economy from 46 sectors that we see to 14 economies as outlined, and of course, the proposals of leveraging our capital market to financialize idle public assets and create more value for the economy. Very insightful presentation. Once again, thank you, Tosin. Now let's get down to the conversation. Proshare analysts have argued that rebasing Nigeria's macroeconomic data and intentional capital market reforms represent the country's most viable path to achieving a 1 trillion GDP by 2030. They also stress that imagination, strategy, and execution are the keys to achieving Nigeria's aspiration of that $1 trillion economy. Joining me for the panel discourse today are Professor Uche Uwaleke, President of the Capital Market Academics of Nigeria, Mrs. Olufemi Adebowale, Head of Research, Parthian Partners Limited, both from the virtual platform. While I have here with me, beginning from my left, Mr. Teslim Shitta-Bey, Director of Research and Chief Economist, Proshare, and to my right, Ademidun Shogo, Head of Corporate Analysis, Proshare. Welcome and nice to have you all. For the first round of questions for our panel session, I'll begin with Professor Uche Uwaleke.
Good morning, Dr. Abasi. Good morning, everyone.
All right, thank you very much. What are the lessons from the 2014 rebasing exercise, and how can the current GDP rebasing efforts enhance the reliability of Nigeria's macroeconomic data for both policy and private sector decision-making?
Once again, let me start by saying I'm indeed honored to be part of this conversation organized by Proshare for 2025. Now, to your question, of course, we can't overemphasize the need for the rebasing. Rebasing is something that ought to have been done every 5 years. The last time we had it, particularly for GDP, was in 2014, as you rightly noted. So 10 years down the line, there is need to have rebase our GDP, particularly so when you have increase in the data economy, knowledge economy, digital economy. We are witnessing a number of new products. We are witnessing a number of, we're also witnessing changes in consumption patterns. And again, perhaps more importantly too, you want to also maintain international comparability. That's why you also need to rebase. Now, when we rebased in 2014, remember the base year was 2010. The GDP went from below $400 billion to about $500 billion, and Nigeria emerged at that time as the biggest economy in Africa. Now, 10 years after, what have we seen? We have dropped from that first position to fourth position, to the point where the GDP number now is, even just as you mentioned, or Tosin mentioned in the presentation, although the one Tosin mentioned was about $100 and something billion using Proshare data, but some other data talks about $362 billion. So, but what's important is GDP has dropped in dollar terms. So, what is the major lesson, or what are the major lessons? For me, it is to recognize the fact that it's not just about the GDP number. So when you have grown your GDP, we expect that this rebasing will also result in a larger GDP number, as even suggested by Tosin in the reports that we are likely to have by Proshare estimation over $400 billion economy. But I also think that by the time the MBS is done with what they're doing using their own methodology, we may have something even a lot much higher, such that the gap between the GDP and the 1 trillion naira becomes quite narrower. So the major lesson for me is the fact that we have to put an eye on exchange rates. The reports, watching the reports by Tosin, there was an attempt to draw a correlation between GDP and inflation. I think what is more important is even the value of the naira, is even the exchange rate. So it'd be nice to look at the relationship, not just between GDP and inflation over the year, but also exchange rate. To what extent has exchange rate GDP is stated in dollar terms? And that it's not just about GDP. By the time we finish replacing our GDP is important. It's not just stability at very high exchange rate. That stability has to happen at the lower exchange rate so that the naira can command value. Exchange rate can be low. So that for me is the major lesson. Putting an eye on inflation, ensuring that inflation is low, and also ensuring that exchange rate is low. So these two prices is important that going forward we have to have control on them. Otherwise, in the next 5-10 years again, the GDP numbers will drop.
Thank you very much, Prof, for your first response. I mean, very insightful. The need to put an eye on exchange rate and, of course, inflation. And we will still go into this conversation. Very interesting start from you. And let's get to you, Funmi. Some quarters are concerned that the rebasing may yield an exaggerated GDP. From your perspective, how will the recalibration of the GDP and, of course, what you call the consumer price index basis impact fiscal and monetary policy decisions?
Yeah, thank you. So I'm happy to be here, and it's a privilege to be part of this discussion. So if we want to look at the performance of an economy, two of the major indicators that you watch is the GDP and inflation. And like Prof mentioned, in 2014, when the GDP was rebased, we saw that there was a sharp increase in the value of GDP. We are going to see the same thing play out this time around, but a major concern is that the increase might not be as much as we saw in 2014 because of the exchange rate impact. And what that means is that there's another devaluation in the value of the exchange rate. The GDP size will also shrink again. Then, if you also look at it, it is a necessary. I think the rebasing is necessary at this point in time because ideally, a country is meant to rebase its GDP and CPI every 5 years. And if you look at it, last time the GDP was rebased, that was in 2014. That's like a decade ago. So it is long overdue. Same thing with inflation. Inflation too is long overdue. So it's a necessary step, and it's that is taken, and it is very necessary and at this point in time. But at the same time, I would like to say that in as much as we're trying to make sure that these two indicators reflect the current economic realities, the process to which we are doing this is very important. Looking at the activities that will be added to the GDP, look at the digital activities, look at modular refineries. They're actually good because since the COVID-19 pandemic, there has been a disruption or sort of some structural shifts in the Nigerian economy, and this has to be reflected in the size of our GDP. But a major concern for me is the illegal activities that will be added to the GDP size, because that is going to actually overstate the true picture of what the size is. It's not about the number, it's about the reflection of what the size of the economy is. And because the economic indicators in themselves, they are not enough, but they are like an input that is being used by policymakers to actually come up with policy. So if you have an overrated or overestimated GDP, it's going to affect the decisions that will be taken by these two bodies, both the monetary authorities and the fiscal authorities. But what I think is, if we can actually streamline the process to having activities that are important and that are legitimate to the GDP size, it's going to give us a true picture of what the size is and not overestimate what the size is, because this is actually critical, as the size of the GDP will influence any decision that will be taken. Then as regards the CPI, we've also known that since the COVID-19 pandemic, there has been a shift in consumer consumption pattern. We're saying because of the work from home, the hybrid mode of work and all that. So we have seen increased use of data, and also it's important that this kind of activity attract a larger weight in the CPI basket. So it is important at this point in time. It's just that the process has to be such that it is not overstated. It truly reflects what the true picture of the Nigerian economy is.
Thank you very much, Funmi. It's very clear. You said the process for how we get the rebasing, especially for the GDP, is important, and it captures the legitimate activity. So we have a true reflection of what the economy is like. Very well articulated. Now let's get to you, Ade. From an analyst perspective, and you've heard what Prof and Funmi has said, how will the rebasing of the GDP and of course the CPI influence the current narrative and understanding of Nigeria's economic structure as it is now?
Okay, thank you very much. Thank you for having me here. So I think I would like to give a synopsis of Nigeria's current economic structure. So in summary, Nigeria can be referred to as a monoculture economy. Monoculture in terms of its revenue generation and also in terms of sectors that drive the economy. So let me break it down. So Nigeria has historically been a country that relies on one sector to generate its effects. So look at it when it was the past in the 90s, it was agriculture. Then we moved to the discovery of oil. And since then, it has always been oil that we've been depending on. So this, we have same also when we look at it in terms of sectors. So recently, we've seen that it's only the service sectors that's actually driving the growth that we're seeing in the economy. So this structure has actually opened it up to some vulnerabilities. It has been susceptible to so many shocks in the global scene. So it has actually affected our indicators. So look at the inflation. Inflation has gone up significantly. We have, look at our FX position. So we have FX deficit. We don't have sufficient, and as reviewed in terms of our exchange rate has depreciated significantly after the devaluation that was done in 2023. So all these factors just gives us a breakdown of how the Nigerian structure is. Then look at it, because we have shortage of revenue, we've relied so much on debt. And because we rely so much on debt, we have been giving us debt sustainability concerns, increase our exposure, and also how we can raise funds. So all these things have a structure. So what would rebasing do there? So rebasing, let me define it in my own terms, is just a computation necessity. It is being done every 5 years, as stated by the previous speakers. So when it's being done, what happens? So going back in 2014, when it was done, we saw that inflation moderated, GDP went up. Those are positive. But subsequent years after that, we saw that a reversal of what happened. So that speaks that the structural problems are not being addressed. So yes, GDP increasing, we have inflation moderating, can signal to investors positively, but it doesn't address the underlying problem. So, and also I wanted to mention earlier that Nigeria has a very large informal sectors. So this rebasing actually allows us to capture more. So we see a shrink in the informal sectors. It's positive. However, there's still some structural problems that need to be addressed. So I want to talk again about the elephant in the room, which is actually the household. So policies, we have plans, projects, always have a trickle-down effect on households. So what does the rebasing mean to household? Necessarily doesn't affect the household because the prices they are getting in the market is still elevated. It is just what the rebasing does is just trying to help us see the current realities using a new base year. And it's good because it captures more. It helps us in terms of the food basket, so you have to capture more. In terms of items, because it has been increased from 700 and something to 900. It's based on the numbers, which is good. It reflects the number, the variety of foods are being consumed, and also the prices. But the structural problems of the country still persist, and it might not necessarily influence it. If the right policies are not being implemented, it is just a temporary, evaluation of the Nigerian economy.
Very well stated, Ade. And I'll come to you, Mr. Teslim. You've heard what Prof has said. Keep an eye on exchange rates, inflation. Ade, Funmi has talked about the importance of the process and capturing the most important sectors and activities that reflect the economy. And you've heard what Ade has said, that it's important to have this rebasing, but of course, it's also important to ensure that policy makers are linking with what is happening, the realities. Monocultural, we want to be a diversified economy. Prof has always pushed for that, having a diversified economy, which is very important. But I would like your views, Mr. Shitta-Bey, on the current GDP state in the country. And looking at this, the possible impacts of this rebasing, especially as we look at targeting a $1 trillion economy and the gaps at this time.
Thank you, Otto. The thing is, I share the opinion of all the previous speakers, They made very valid points. Now, what does the GDP represent? It represents the total output of an economy within a specific period, usually considered to be a year. That's what GDP is. How much have we produced as a country? And what rebasing really states is that, okay, let's be sure of the value of the total quantity of goods and services produced in that economy. So like Ade had pointed out, it's really just a number, right? So it doesn't necessarily translate into improvements in the real sector of the economy. It just gives us an idea of how big or how small that sector is. And then Professor Uwaleke made a very fundamental remark when he said, when you're looking at GDP, you're looking at, when we look at nominal GDP, we're looking at price and we're looking at quantity. Now, the report of Proshare emphasizes the price. We saw inflation adjustments going up. Currently, inflation is at 34.6%. So we've also seen quantity. But that quantity wasn't captured properly because of the wrong base. Or don't let me say the wrong base, but the fact that we haven't consistently adjusted those bases after every 5 years. So we've stalled a bit on that. But Prof's argument on foreign exchange is critical. And it's one of the important points we emphasize in our report, actually. We believe that foreign exchange is responsible for between 60 and 65% of domestic inflation. And that's why when Tosin was talking, he showed that chart that no matter how much we move the monetary policy rate, it's not likely to move the needle of inflation. Domestic inflation won't likely move. What we need to do, basically, is to see how we can increase foreign reserves, which is what Prof was actually referring to. So foreign reserve is inadequate. That foreign reserve scarcity translates into the high level of domestic prices we currently see. And so I agree, Prof, there totally, that there is a need to address the foreign reserve question. And of course, Tosin actually also implicitly provided some way out of addressing that when he talked about financialization and securitization. We could go into those issues later, but I think those were very important. And then I agree with Funmi. There is some concern about the GDP and illegal activities. When you're looking at GDP, should we bring in part of the quote unquote illegal activities, or should we leave it out? That is a question for the MBS and the Nigerian populace to decide upon. But I must say this. Europe has veered or detoured towards integrating some of those illicit activities in their GDP. So if we're going to compare GDP to GDP, if we don't put some of those activities and Europe puts those activities, how do we compare between the economies? Because you have some economies that are having it in and some that are taking it out. And of course, if you take it out, currently it's estimated at about $146 billion. And if you add that to what we have in Nigeria, that's pretty sizable, right? So it is an important issue we need to address. Should we do that? However, there is something that Proshare has noticed. We don't call it illicit economy, actually, we call it hidden economy. And there is a danger, actually, in trying to measure the hidden economy in doing double counting. Because some of the expenditure and some of the output in the public sector ends up in some activities in the private sector, which we have reclassified as construction economy. I won't go into details, but generally speaking, the construction sector has moved very rapidly because of some of those activities in other sectors of the economy, which are hidden.
Thank you very much, Mr. Shitta-Bey. At least you've talked about the fact that if Europe is doing the illegal plus illegal activities capture in their GDP, it's a huge debate. But I mean, like what has been presented by Tosin, we need to begin to look at that recalibration, like Proshare is pushing 14 active economies. If those ones are captured, I think it really makes a whole lot. But of course, the conversation continues and we're going to a second round of questions. And for this round, I would expect that our discussants will give their response in 3 minutes. But the conversation is very, very interesting. I mean, I believe our participants are learning a lot. Prof, I'll come to you. First, what are the linkages between the rebasing of the new economy that is the headroom available and the productivity incentives required to deliver that target $1 trillion economy?
Thank you so much. Just very quickly, let me speak to this issue of legal activities. We say GDP, monetary value of goods and services produced, an economy within a particular period. And one way to look at GDP, if you look at the national income accounting, consumption expenditure by households, you add that to what investment by firms, you add government spending, and then net exports and expenditure approach, so that gives you GDP. Now, if you use that, you can argue be accommodated. If you want to get the true value of an economy, then you should include those illicit activities, whether activities from drug trade, and so on and so forth. But essentially including illicit activities in our own GDP computation, because it raises two issues. The first is that you are, by so doing, you are legitimizing it. You legitimize illegal activity. The second issue also has to do with the even that of estimation. How do you estimate their values, unlike what happens in Europe? Now, again, it is not for nothing that there's no African country or no developing economy that includes illicit activities in the computation of their GDP. As a matter of fact, it's only in the Euro area. It is only the 27 countries of the European Union that do that. US and Canada don't explicitly include illicit activities in their computation of GDP. So I think we should exclude such activities and stay with the ones that are legitimate. Now, having said that, the other issue I want to respond to very quickly is the impact on households. Very important. Now, yes, I agree, GDP is a number. It's only a number, but we also know that GDP is a necessary condition for the ultimate. The ultimate is economic development. It's not sufficient, but it's a necessary condition. So if we rebase and we have a bigger pie, that is now known, one thing it can do is that it has the potential of attracting investors. So it can signal to investors, yes, you have a bigger economy, and investors might want to come on that basis. It can also increase, to a large extent, our profile, our credit profile in the international, committee of creditors. So when you have a bigger GDP, remember too, is the income approach, talks about income. So it gives impression that income in that economy, has improved. And so a foreign investor might, on that basis, want to come and do business in Nigeria. So to that extent, it can help to create jobs. To that extent, it can also indirectly also impact households. So that's my point. It's good we are doing it, and it's also good we are bringing the base here very close, 2019 for GDP rebasing. On the issue of CPI rebasing, now very quickly, what I have, my concern there is the fact that we are bringing the reference, the weight and price reference periods very close to 25 years. That's, if you like, that's desirable. But again, using 2024 as the base period, when we know that that's 1 year that experienced a lot of shocks, particularly price shocks, we are likely going to run into the challenge of base effect. So there will be a base effect that will now work to reduce the inflation rate ultimately to even single digit. You may end up having a single digit inflation rate by the time that they are done, and that may not correctly reflect how prices have changed over the years. So I think 2024 might not be a good year to use as a reference period with respect to CPI computation, because it may produce a spurious outcome. The like we saw when we had the unemployment figure suddenly crashing from 33.3% in Q4 of 2020 to 4.33% or so by 2023 August. And of course, we know that up to today, that figure has been somehow contentious. Now back to the question you asked. Yes, how the GDP rebasing essentially, as has been rightly defined, you're changing, you're trying to capture a lot of the structural shifts that are happening in the economy, and then of course include a number of new products, particularly now that as I mentioned earlier, the knowledge economy, digital economy, data economy is on the rise. Now, what are those things that particularly on the part of government we need to do? I have an acronym that I've used to summarize them, which of course also speaks to the suggestions that Proshare has made in this report. That acronym is the IPO approach. IPO approach. The idea stands for incentives. Government needs to give incentives, particularly if we want to use the capital market to, as one route to achieve that $1 trillion economy. Incentives to a lot of companies that are out there that are, that may be willing to list on the exchange that are not listed. Today, as we speak, the exchange just has 153 companies that are listed. South Africa, Johannesburg Securities Stock Exchange has as many as 274. And we have the potential to have many more companies, list, on the exchange. So incentives are necessary for that to happen. The other one, the P there stands for privatization. We need to privatize a number of government assets through the capital market. Okay, so that is important. And the O there is about optimizing the assets. Now, talking about privatization, one thing I have in mind too is about the government can even start with the NMPC. The NMPC, part of the NMPC can be 10% of NMPC shares can be listed on the exchange in 2025, or at least let us have a program of doing that within the next 2 years. Then the issue of optimization. First is optimizing dead assets, which you have also talked about. Financializing, that's the word you used, of these assets. I quite agree. And Murphy, I'm aware Murphy has developed, if you like, an assets register, for that purpose. So we need to move fast in the area of optimizing, the values of assets that are, you may consider dead, particularly those assets in the oil, the government oil assets and the real estate assets. Then there is also the issue of optimizing the instruments that the government is even using to take long-term loans from the capital market. Okay, we have to optimize those instruments. It's not just enough to say we want to borrow. For example, in 2025 budget, we have a 13 trillion naira deficit, out of which just 300 and something billion will be for privatization proceeds. The rest are going to be borrowed. And out of the borrowing, 9.3 trillion represents new borrowing. And government says much of that will happen in the domestic market. And I'm saying that even if we are going to do that, we should rely less on FGM bonds as an instrument to take loans, because the FGM bonds have a lot of discretionary feature. They are not specifically tied to projects. So that's what I mean by optimizing. So if we are borrowing this time, we should use more of infrastructure funds, use more of sukuk, use more of green bonds, to borrow from the capital market, knowing full well that when we do that, these proceeds are tied, to specific projects. So it's also in line with what your report is suggesting about, using the capital market to drive the $1 trillion economy. So the IPO approach, in my view, is what the government, should adopt to, make the change happen. Thank you.
Thank you very much, Prof. The incentives, privatization, and optimization of assets and instruments, IPO, very interesting acronym for how we can begin to reposition the market and target the $1 trillion economy. Very nice insights from Prof. Now, Funmi, which activity sector should become the focal point to bridge the growth gaps and align the capital market's potential with the country's economic growth targets, whereby market cap to GDP becomes very, very phenomenal?
Yeah, thank you. So before I answer the question, I would like to portray on what Prof said about the base year for inflation. The price reference there is 2023, and according to the IMF report, your base year can be a year before, a year after. And there was a discussion between NBS and NESG last year, where 2022 was adopted as the base year. But now it's 2024. One of the reasons that was given by one of the top officials in NBS is because they said it was difficult getting data points for some of the activities that they intended to add to the to the GDP side and all. But I think that in as much as we might face challenges with data gathering, it is important that in the process of rebasing the CPI, we do not fall into another problem where the number do not even reflect what the economy is. So I think the focal point or what our attention should be on is having a data that truly reflects what the state of the economy is. Then actually, like the question you asked, so the focal point for us is to focus more on the real sector. If you look at the GDP numbers that were released in the last couple of quarters, it has been largely driven by the services sector. See, it is not enough to have a large GDP size. If it's not having an impact on an ordinary Nigerian, if it's not having a trickle-down effect, then it's not totally useful. I'm not saying it's not important, it's not totally useful. So it is important that if you look at the services sector, what percentage of the population do that sector employ compared to the real sector? And sectors like agri and manufacturing, they've been underperforming, and that's due to a number of challenges. So I think these challenges in the sense of having robust capital for infrastructure development and all, we have to look at that. Addressing that challenge is very key for us to be able to achieve the $1 trillion economy. It is achievable, but it requires a lot of hard work. So focusing on the growth sector, the agri sector, the manufacturing sector, to be able to address the challenges and employ more people that is going to have a trickle-down effect on the welfare of an individual is very important at this time. And the capital market will provide the benchmark or the platform for this sector to be able to leverage on to grow. For instance, for agri, most of the agricultural sector has relied solely on traditional means. So they need to, move fast into the digital economy where, we rely on digital tools to be able to boost productivity in that sector. So we're not just relying on the production throughout the value chain of the agricultural sector. A lot of investment has to be put in place. And the capital sector will play a role in the sense that you can get capital, long-term capital, because infrastructure projects require long-term funding. Because you have enough time to be able to, be able to productively use the fund, be able to pay back the principal, and also have funds to continue to maintain that infrastructure. And the capital market will actually provide that. Looking at bonds where you can get funding for at least 5 years, 20 years and above, it will give you that leverage of time to be able to use the fund and effectively use the fund to be able to achieve your objective. So the road sector is actually critical to achieving this $1 trillion economy in Nigeria.
Yeah, thank you very much, Funmi. Very, very, very wonderful perspective on the need to focus on the real sector. Very important because it trickles to the households, which of course Proshare has huge interest in how the economy impacts the household, and the market, like you said, has a big role to play, providing instruments like bonds. Quite insightful there. Now, let me ask you, Ade, some of the analysts have argued that 2021 would be a viable base in terms of proposed rebasing as the normal principle. But what are your thoughts on what the National Bureau of Statistics is taking 2019 as the base year? I mean, what are your thoughts around this approach? Does it also reflect the normality principle, and what would be different in both cases?
Okay, thank you very much. So as regards that, there are basically two schools of thought, and we have the 2021 and also people that believe that 2019 should be the appropriate one. So I'm going to look at it through the lens of the requirement. The requirement is to look for a year that has minimal disruptions. That's it, because we have to look at that to prevent an overstating and understating of it. So in both years, let's start with 2019. 2019 is the year that the country what seems to have recovered fully from the 2016 recession. So if you look at the GDP numbers, that's when we had the highest GDP we have in terms of the nominal value post 2016 recession. So there wasn't really any destruction like that. That was before COVID-19. Then we came into 2019. We have 2019, actually, we have the COVID-19 storm actually started, but it was towards the end of the year. So it wasn't reflected because we were projecting data. The data still being inputted in this period did not reflect what was happening. So going into 2022, we saw a full force revelation of what happened in COVID and how it affected it. It pulled Nigerian economy into a recession. So we had a negative growth. Going into 2021, it was a recovery year. So it still had some bit of the COVID-19 impact in 2021. So with that analysis, it shows that the 2019 seems to have lesser disruption relative to the 2021. And after 2021, there's been several disruptions. We had the Russia-Ukraine war, the banking turmoil, where we had like 3 or 4 banks collapsed, nearly collapsed rather. So because of that, 2019 has been like the year that seems to have less, the closest years that seems to have less disruptions rather than that. So what will be the impact? So using 2019, we have, with minimal disruptions, it seems to show us a true reflection compared to this current year. Yes. Compared to 2021. 2021, we have recovery, was a slow recovery from COVID-19. So it might understate the true reality of the Nigerian economy. And I think that those people have a point because they want to look at it through the lens of the COVID-19. Some countries are still yet to recover fully from the COVID-19 with the Russia-Ukraine war still compounding the effect. If you can look at our inflation figures too, inflation has hedged higher since the COVID-19 and is still struggling to tip down, aside from the structural issues that we have in the country. So I think that both points of view are fair, but the 2019 seems like the one that has the minimal disruption the most and should be the appropriate year to use.
Okay. 2019 is the most appropriate one for the normality principle because of minimal disruptions. Let me come to you, Mr. Shitta-Bey. The conversation is getting very interesting, especially around the process of rebasing, the sectors that we should look at. And of course, Ade has talked about the normality principle, what we should take, which is 2019, when we had minimal disruptions. But Proshare analysts have argued that the large array of sectors somewhat weakened allocation and monitoring and recalibration of the sectors. Now it's into 14 sub-economies, as Proshare has put out. Can you share Proshare's position further in terms of this recalibration and how it's necessary for productivity and growth for our country?
Okay, yes, I can. But quickly, I want to thank Prof for his IPO. Yes, why I'm excited about it is that it's what Prof and other academics call a double entendre. And what that means basically is that it has double meaning, right? Because if you want to raise fresh capital from the equities market, you do initial public offer. So the IPO looks like, okay, new money coming in for businesses, for the government, there's an IPO. So this IPO concept really aligns closely with Proshare's perspective of the need to leverage the capital market to be able to consistently grow the Nigerian economy to the $1 trillion economy we expect. And the quick thing I'd like to say here also is, before I answer that question directly, is that the base for GDP is different from the base that you use for inflation, the CPI, right? They have different bases. And conventionally, what happens is this: for the GDP, you're either using a fixed base or you are using what is called a chain-linked base. That means that annually, you continue to adjust it, which is what we see in Francophone West African countries, where annually they adjust their GDP. So they continue to rebase it on a continuous basis. That's why it's called chain-linked, right? So the choice, as I agree with Ade, for 2019 would seemingly be quite reasonable, but the contention has been CPI, not necessarily GDP. So it's been the CPI. Should we use 2024? Well, the reason I understand that 2024 was used was basically because the convention globally is that you use a year before or a year after that stable year. And they considered that 2024 was a relatively stable year. Pass-through effects, like Ade had talked about, of COVID-19 had petered out. And so 2024 wouldn't be too bad a year. And of course, the pass-through effects of removal of subsidies, right, also has happened. And so 2025 might not be that bad. I think that's the logic behind that. Now, to your question, where we look at the collapse of 46 sectors into 14 sub-economies. Now, the thing about it for us is this. One of the things the chairman always emphasizes in Proshare is keep it simple. The complexity of 46 sectors can actually be reduced into simpler sub-economies. And addressing those sub-economies makes it easier for policy execution. Proshare has a philosophy. There should be a whole of government approach and a whole of society approach to policy programs. Yes. So what we have decided to do is to say that, you know what, yes, there are these 46 sectors, but let's collapse them into 14 key economies. One of the key economies is the blue economy. That's a new economy, a fresh economy. So how do all these government agencies come together to play in that area? Because there's an agricultural element of the blue economy. There's an energy element of the blue economy, right? So there's a marine transportation, what we call the mobility economy element. So there's an integration of these 14 elements. But what we're saying is that policy collaboration should be such that they're focused on just these narrow 14 areas, and we'll be fine as a country. Rather than worry ourselves about 46 odd items, that we're looking at economies, sub-economies, and concentrate on those sub-economies and leverage those sub-economies for the $1 trillion expectation that we have for 2030. So another sub-economy that I think I should mention is the creative economy. So it's not just about, and the creative economy, I think it was Funmi that was mentioning how many people are employed, the real sector. So the creative economy, you have somebody who's going to sing a song. There's a songwriter, right? There's a video. So there's a video director. There's a lighting director, the director of photography. There are those who dance, choreography. So there's so much. You need cameras. You need so many things. So it's an economy. But how do all those economies, how those various activities within that economy, how do they link up? Which ministries are responsible for what? So they all come into that creative economy. And it's not just music, it's also about movies, right? It's also about arts, generally, you know? So we're saying, let's take the 46 sectors and collapse them into 14 economies and look at how different ministries collaborate in a whole of government approach to address issues of those sub-economies. So that's what Proshare did in his recent report.
Very incisive, Mr. Shitta-Bey. And looking at having those 14 sub-economies, it now dovetails into what Prof is saying, that we can begin to really attract the investments. You know, when you have 14 sub-economies, foreign investors see these are the core areas, we begin to attract more investments and really, really helps the economy. Very interesting second round. Now we're going to the third round and final round. I know I said initially that the answers should be within 3 minutes, but it's very interesting. And of course, I would appreciate again, as we take this final round, we keep it to 3 minutes. Prof, how will the GDP and CPI rebasing exercise impact businesses' performance? And what are the implications of rebasing for the private sector, which is viewed as very key driver of the economy?
Well, thank you, Dr. Abasi. You know, I had alluded to it when I talked about the fact that, yes, is a number, GDP is a number, but there is also, for me, the signaling element. There isn't any time, but I was in Banjul and Conakry last month, also talking to some people from the ECOWAS, finance expert from ECOWAS member countries. And during the introduction, I introduced myself and I said, of course, I'm from Nigeria, the biggest economy in West Africa. Okay, it made an impression. Before then, it was biggest economy in Africa. I'm just saying that somebody outside Nigeria can, on the basis of that, you know, decide to come and do business with you, knowing full well that there are prospects. So it represents some potential. Some can see the potential in size. And if a foreign investor is coming here, for example, on the basis of that strength of that, you can imagine the multiplier effect it can have on not just firms but also on households. Let me also quickly chip in something here with respect to, you know, with respect to the 2019 base year, GDP base year. One of the reasons the MBS, you know, gave for using 2019, in addition to being a year that didn't really experience a lot of uncertainty, is the fact that that was the year they, you know, conducted a survey and got most of the data that that will be used for the rebasing. 2018-2019 was when they did the National Living Standard Survey. The latest of that was in 2023, but they had one in 2018 and 2019, and much of that will serve as input in the GDP rebasing that that they're going to do. And I also think it's also important to emphasize something you mentioned during the Proshare mentioned in the reports when Tosin was presenting. I think the chairman too mentioned it in his speech, and that's talking about foundational enablers. I think to quote the chairman, he used that term, foundational enablers. So that is critical. We can't be talking about a $1 trillion economy without these foundational enablers. And for me, the critical one is energy. When I'm talking about energy, I'm talking about not just the petroleum products, but also electricity. So electricity is critical, okay, for us to achieve $1 trillion economy. No matter the sector you're talking about, if if the electricity situation is poor, if we are still dealing with 3,000 megawatts of electricity, when South Africa, for example, 65 million people have as much as 40,000 megawatts, of course you can't compete. So for me, foundational enablers are very critical. We have to focus on that, getting the private sector as much as possible to support that the provision of those enablers, namely electricity and broadband infrastructure. These are the two enablers that I think will further drive the knowledge economy, the digital economy. We can't improve on them without these foundational enablers. Finally, let me also say that part of why I'm optimistic about 2025 is the fact that I also expect that 2025 will experience a lot more macro stability than we saw in 2024. Now, talking about interest rates, the report was very clear, and I agree that no matter how much you increase the MPR, the impact, particularly on inflation, is insignificant, in my view. And the report has used data to justify that. So I expect that in 2025, the central bank will not only pause interest rate hikes. I expect that they start doing that by this January. But of course, in subsequent quarters, even consider easing monetary policy. So the more stable macro environment will also provide foster an environment that will enable this $1 trillion economy we're talking about. So low interest rate environment is key for businesses to thrive, because if you look at the GDP growth rate for manufacturing and agriculture, for example, manufacturing, the last one we saw was 0.9%. For agriculture, 1.14%. These are typical growth, and these are sectors, even using the current arrangement, agriculture contributing 28% to GDP, manufacturing 8% to GDP. The economy cannot, experience inclusive growth, with these two sectors, productive sectors, lagging behind. So, low interest rate environment is critical. I'm also optimistic that the banking sector recapitalization will further gain traction in 2025. We'll see more activity, primary market activity, in the capital market in 2025. The recent move by the central bank again to introduce the electronic foreign exchange management system will further help to stabilize the forex markets. And stability in the forex market is also needed for the economy to grow in 2025. And then there is also this the non-resident investment account that the central bank has also launched. I also think that will further help to bring in that diaspora remittances. And the moment we continue to experience accretion to our foreign reserves that stand at over $40 billion today, you can be sure that the central bank will be in a stronger position to defend the naira, when that becomes necessary. Because as I earlier noted, exchange rate is very key to even this GDP rebasing, that we're doing. And then finally, I also think the currency swap arrangement will be positive for Nigeria, especially now that the president is asking for the size to be increased. Once we're able to increase the size, including through issuance of panda bonds, because that for me is going to be the next step. The government is likely going to do a panda bond issuance with the view for the purpose of increasing the size of the yuan in our foreign reserves. So that will further, of course, reduce the pressure on the dollar and help the exchange rate for me, which is very critical. So it's not about stabilizing the exchange rate. For me, it is more about, in my view, to help us, move to that. Thank you.
All right, thank you very much, Prof. I mean, the foundation enablers that you have reinforced and agree with Chairman is very critical. The infrastructure of power, as energy and digital enablers, and of course, the need for us to really have those enabling reforms that attract investment and a low interest rates regime. And of course, re-emphasizing foreign reserve adequacy, very critical for improving business performance and economy. Thank you very much, Prof. I'll get to you now, Funmi. Does the capital market have a role in bridging the growth gaps? Some analysts argue that heavy lifting is required to deliver on the market determination of sovereign assets through securitization and financialization, opening the space for the expected GDP growth. As you know, Proshare has really emphasized a lot about the need to leverage the capital market through those steps.
Yeah, that's very true. The capital market has a pivotal role to play in achieving that target. The reason is because it's a channel where long-term financing can be gotten. So it has a role to play. And if you look at the challenges that have been faced, especially by the sectors that have utmost importance to the economy, most of those challenges require long-term funding, and the capital market will actually provide that. So the role of the market is beyond just raising capital for companies, but it also provides the mechanism for channeling, channel resources into the critical sector, and it also helps to promote, economic diversification. And it's also a platform where you can get, funds from both local and foreign investors. So it has a significant role to play, considering the fact that the challenges we are facing, they are not challenges that mostly require short-term capital. They require mostly long-term capital. If you're investing in infrastructure, you need a capital that can give you enough time to be able to, productively use the fund and, achieve your goals. So the capital market has a very pivotal role to play for Nigeria to actually achieve its target.
We're optimistic that at the federal and subnational we'll begin to see more activities in that regard, and that will be very good for the economy. Let me get to you, Ade. From an analyst perspective, what are the most significant structural and policy steps at this time, bottlenecks that have hindered the country, the bottlenecks that have hindered Nigeria from the capital market and from playing its pivotal role in growing the economy, which is very critical at this time? And how can these disruptions or bottlenecks be removed?
Okay, I think I want to start from looking at how does the Nigerian economy mirror the capital market. So there seems to be a disconnect in terms of the representation of sectors on Nigerian capital market. So let's look at it from the lens of the equities market. How many sectors are there on the equities market relative to the 46 sectors that we have in the Nigerian economy? So for instance, now look at the power sector. Thanks for the listing of Gorego in 2021. Before that, we never had. Now we've seen another listing in 2024 that added Transcorp to it. We have agricultural sector is also a very small component of it, while we have the likes of the banking sector taking a significant portion of the equities market. So the Nigeria is not well represented on the exchange. We have on the exchange itself. Then let us look at it from the narrative of what the capital market is supposed to do. So capital market is meant for capital formation, but Nigerians' capital market seems to have deviated subtly from that path. It seems to be more towards investment and return incentives. So what I'm saying that is that how many IPOs have we had in the past few years? We've not seen. We've always seen listing by the introduction. So that is a major concern. I know that we have return generation and investment is also very important, but it's not the main focus. So we need to pivot and move back to capital formation. So what are the regulators going to do to stimulate sectors to list in there? We have to list sectors, viable sectors. How do we want to do that? I think Proshare has actually made an argument that we should see the public sector actually come to the market so that they are the one showing the private sector that yes, they can be listed and be able to generate as much expansion, capital that they need for their expansion. So if you have the likes of NNPC being listed on the exchange, that's going to be a very good incentive, yes, to them. So what are the incentives being kept in place by the regulators to stimulate people? I think there was one time they proposed a tax benefit. Have they implemented it? Yes. What are they going to do in their likes? Also, we have to talk about Nigerians' financial literacy. So financial inclusion has increased sporadically, I think 70%, but is it reflected in our markets? So there seems to be a shallowness in terms of we have what people's understanding of the capital market. What is the regulator going to do as regards the promotion? So the new SEC, we have a new SEC board. Yes, what are their strategies, their policies that are being kept in place for them to actually say we want to promote market inclusion this time around? So what are the trainings? Is it going to the secondary school level? Is it going to the tertiary institution to educate people? Because it seems that there's a knowledge gap that is affecting the participation. I know that there's an after effect of the market crash in 2008 that still sort of affected the retail participation in the market, because it's still lower than 20%. If you check it based on the equities market, it's still the retail participation is less than 20%. We have the institutional taking a significant portion of the market. So what are the policies being put in place in order to stimulate retail participants in the market? Then I'll look at it also from the fixed income arm. We have the government has dominated that arm. Yes, I know that they need to bridge the gap between the budgets because of the shortage in revenue. But there's no room for the private sector. Exactly. There's a crowding out of the private sector consistently over the years. Based on 2024 data, we saw that based on the new insurance alone, we have all government instruments accounted for over 90%. So less than 10% for the private sectors. Then the interest rate environment is not suitable for the private sector to come to the market. Then also when they come about the compliance, they talk about the requirement seems to be so stringent and it is not favorable to them. So what are the policies being put in place to address some of these conditions? I think those are the things that they need to work on. Then policy inconsistency. Nigeria is being tagged to have inconsistent policies. Those are uncertainties that affect sectors. Companies, if you look at it down, companies are exposed to inconsistencies of policy and they might want to shield themselves by not being public. So what are we going to address in that light in order to prevent that inconsistency trickling down to how our firms are faring and how they want to make their financials win public by being listed? So it is time for us to look at it. What are the assets that we can list? Let the public sector take the fourth footing in order to attract the private sectors, because we've seen a lot of delisting on the exchange of late. Then maybe it's time for the government to look for a way to expand their revenue and not rely solely on domestic borrowing. Because reliance on borrowing is significantly crowding out private sectors from coming to the debt market.
Very clear. The public sector must take the front burner in terms of leveraging the capital market. And like Prof said, we're optimistic that the government will take this seriously, the market. As we round up this session, Mr. Shitta-Bey, can you share your thoughts briefly? We've talked about it, but on the impact of the weights and the impact of the weights in terms of looking at the sub-economies you've talked about. If we're going to look at it, what will be the impact of having the weights in these sub-economies?
You know, all I'll also say is this. I'll prefer participants to read the report and see what we have done in the report. They will see how we weighted the sub-economies and how we've treated the broad economy. I'll just leave it at that, if you don't mind.
Very nice. That creates what you call the appetizer and the desire to look at it. Thank you very much, Mr. Shitta-Bey. And a very, very interesting conversation we've had looking at the 2025 capital market report launched by Proshare. I mean, very, very interesting insights.
Okay, well, the short answer to that is, well, the MBS recognizes, I'm not speaking for MBS, but MBS recognizes the fact that it has to be done every 5 years. I've also had the privilege of participating in a number of stakeholders engagements organized by MBS, particularly the ones in Abuja. And I know that one of the things MBS would say is that part of the challenge of rebasing every 5 years or so has to do with funding. So it is about funding. If they, of course, had the funds, they would do that every 5 years. So it's largely a funding challenge.
Okay, Prof. Thank you very much, Mr. Shitta-Bey.
Yes, I think I agree with Prof totally. I've had the privilege of having conversations with senior National Bureau of Statistics officials, and they've mentioned the problem of funding, and the funding relates to being able to do surveys. One of the things we thought was that the MBS could decide to do a chain-linked rebasing, where they don't necessarily do the surveys, but off the back of a previous survey, you can do some extrapolations. That is indicative. It doesn't show the final figure, but it does show in the interim, they can go on with the surveys and come up with the rebasing based on what we call a fixed-based methodology. So the problem is basically that of conducting surveys. I am hopeful that, because we had a conversation, I think, last week, I'm hopeful that the government, recognizing the importance of the exercise, will adequately make arrangements to ensure that they made a commitment that it will be, from henceforth, it will be every 5 years, half decade. So I'm sure that that will be addressed.
Thank you very much, Mr. Shitta-Bey. We expect, I mean, it's been a very interesting conversation, and as we expect comments and questions, for those who have not sent in yet, we would expect that they would send in much later. We would, of course, engage at the moment. But I think it's been a very interesting conversation, and people really are getting insights so far from this very wonderful session. So I would like to give our panelists a closing thought, for your closing thoughts on this conversation. And it's been a very wonderful one. So I'll begin with Prof, your closing thoughts.
Well, thank you for the part of this. I am very, very optimistic about 2025. And I also think the rebasing GDP and CPI, they are necessary. And I have no doubt that the economy will attain the $1 trillion target by 2030 if the suggestions that you have made here in your report, if they are taken and implemented.
Thank you very, very much, Prof. And we'll move now to, yes, the next person on the line is Funmi. What's your closing thoughts?
Thank you. So, like Prof mentioned, I'm so optimistic about 2025. The steps that have been taken, or the initiatives, they are good ones. Just that we have to also be careful to ensure that the processes actually give us an accurate data that will help to have an informed policy making. That will not just, we're not just having a robust economy, but these policies is going to trickle down to having a positive impact in the life of an average Nigerian.
All right, Ade, over to you.
Okay, thank you very much. Yes, the rebasing is necessary. Yeah, it's essential because data is so important to policy directions and influences every other sectors of the economy. But I feel like it's time for us to also address our structural issues. So beyond rebasing and making data available, what are the steps being done to address the structural issues? The options that have been listed in our reports should be harnessed and reviewed and being implemented. We will see us being able to achieve the 1 trillion economy. If not, it's going to be a promise of hope, and hope that we've had all over the years, and we're unable to achieve it.
And now to you, Mr. Shitta-Bey, for your
thank you. I agree with the optimism shared by all the panelists. But I must say that it is important that we decide to look at the capital market more as an opportunity for capital formation than just for earning investment returns. That's very critical. It is important that beyond numbers, policies, programs, and overall philosophy of governance should be towards enhancing the welfare of the household. Now, the household welfare goes beyond just numbers. It goes to initiating, activating certain policies that actually grow the real sector of the economy, as distinct from the nominal sector of the economy. And on the final note, therefore, people should kindly review Proshare's positions in its recently released report, where we provide not answers, but suggestions on how Nigeria can attain the $1 trillion economy by 2030.
Very well, because like what you said, I mean, the key takeaways I see here is the need, of course, the recalibration of our economies from 46 sectors to 14 sub-economies. These 14 sub-economies create that enabler to attract investments, create more policy incentives, and also create opportunity to deepen our economy and unlock economic opportunities for Nigerians. And also the agreement among the discussants, which of course is also a position that Proshare takes, that it's time to leverage the capital markets. And there is the need to take the approach of what Prof has said, the IPO, which is looking at those incentives, looking at those privatization steps and the optimization of instruments and assets in public assets that can unlock wealth for the country. We've seen it happen in Saudi Arabia, we've seen it happen in Brazil, and even in India. It can happen also in Nigeria. And also the need to ensure that the foundation enablers, as raised by our chairman in his opening remarks, which Prof agrees with, are addressed. Enablers like energy, and of course digital infrastructure that begins to allow our economy to become deepened. And of course the process for the rebasing must capture, as the discussants have agreed, the legal activities, legitimizing productivity and growth. And finally, it is a very, very wonderful conversation we've had today. And like Mr. Teslim Shitta-Bey has said, you can get all of this encapsulated in our reports. Very rich report that has suggestions that can move our economy forward, linking with the capital markets. So thank you once again to all our panelists. Thank you. I'll now yield to our Head of Business and Markets, Olajumoke Adeye, to give her closing remarks.
Thank you, Otto Abasi, for moderating the session. And we have come to the end of the event, and I would like to express our sincere gratitude to the speakers and the moderator once again for expertly guiding the discussions. I believe that we've got a lot of insights, as well as we've received a bit of solutions that we can apply to the rebasing of the capital market. Now, a special thank you also goes out to all our attendees for your active participation, and to the Proshare team for ensuring seamless execution of today's event. We've taken note of all observations, commentaries, and polls from this event, and we'll distill them to guide future interventions on the theme. As a follow-up to this session, we invite you to join us for the January edition of Proshare Hard Facts, featuring Mr. Johnson Chukwu, the Group Managing Director / CEO of Carry Asset Management Limited, as it discusses unlocking Nigeria's economic prosperity through the capital markets. This session is scheduled for 10 a.m. on Friday, January 17, 2025. I mean, this Friday. And will be live streamed on our Web TV YouTube page, as well as our Proshare X. To stay informed with timely updates and insights, kindly subscribe to our Market Intelligence Note and follow us across our social media platform displayed on the screen. Till next time, I wish you a prosperous 2025. Goodbye for now.